Good day, fellow investors. We recently discussed our value investing risk and reward quadrant, and CNH Industrial is here teetering on is it a buy, isn't it a buy. So we'll now check where to place it after the quarterly earnings came out. And for those that need a reminder, David Einhorn said a few months ago that CNH Industrial is a good buy for the long term, offering 10 plus earnings yields and growth. And if you type into Google David Einhorn CNH, here is our first initial video. However, yearly earnings are out, and with all my covered stocks, this is what I do now. I completely rewrite, recheck the thesis in order to give you a better risk and reward perspective on when, where a stock is a buy, what to wait, what to look for, what to watch, and that's what we are going to do in this video. Business overview, the cycle discussion, stock valuation, intrinsic value, comparison, a little bit what's going on with the competitors, and then of course see how it fits our long-term 10-year horizon risk and reward quadrant investing. Let's immediately start with the business overview. It is predominantly an agriculture, machine, equipment company, and there is also part of the business that is construction equipment. The family of brands, Case and New Holland, are the key brands there, and then there are other smaller brands. When it comes to food stocks or agriculture-related stocks, it is all about food prices. A few years ago, food prices boomed, 2021, 22, slowing down in 23, but high food prices lead to farmers buying more equipment because suddenly it pays much more to have better new equipment compared to other old equipment. You can do more, you can sell more, you can be more profitable. So this is the cycle that also impacts the company here. We have higher food prices. Now food prices are low. Farmers already bought their inventory and sales are declining. But this is then a cycle. If farmers buy less inventory, food prices are down, but with less investments, at some point in time, you see these food price spikes, then high investments, low price, high price, investments, low price, and that is the normal food cycle that one has to watch. When it comes to the business with the current earnings out, we have reducing inventory because if more growth was expected, now there is less growth or a decline, then you have to manage your inventories, you have to save. So they have achieved 600 million on annual run rate savings. They are lowering production hours, lowering everything. So they are trying to manage the cyclical downturn. If we look at how big the downturn is, consolidated revenues down 28%, which is staggering for any business, but usually not that uncommon in a cyclical food agricultural business. Consequently, EBIT is down 71%, net income 70%, and diluted earnings per share down 30 cents to just 14 cents for the quarter. Those are big hits, but that is the nature of cyclical investments. The start of the year was a little bit better, so revenues are down just 20%, 47%, 45% down net income, and also significant decline in earnings per share. However, if we look at the business highlights, they are now focusing on inventory, looking at sales campaigns over the week industry, lowering hours in production for less inventory. They are just adjusting to the cycle, and they also have the big financial services business that for now is stable. If we look a little bit more deeper into the numbers, the negative trend has intensified in the latter part of 2024, and they also expect that to continue at least in the first two quarters of 2025. So maybe 2025 will reach bottom and stabilize, and that's something we need to bring forward later into analyzing when this is a stock to buy or not. Gross margins down a little bit, net sales down big for agriculture, also profitability down big, so from 12% EBIT going down to 7% and perhaps even lower. Maybe it will stabilize there. Construction also impacted on lower demand, especially in the US, but margins are stable there. So again, going forward across cycles. Financial services, that is stable. Delinquencies have increased just a little bit, but food prices, as we have seen, are still okay, which means farmers are likely still profitable, which means then lower delinquencies. But if this changes, if the food downturn continues, fortunately it has stabilized, so that is something also to watch, because a lot of their equipment sales is financed by them, and that is an additional profit, but also an additional risk when it comes to investing. If we look at their agenda, they want to reduce costs, but they are still investing, so trying to manage the downturn as good as they can. They are investing in organic growth, more than $1 billion, so they are really investing in technology, healthy investment grade credit rating. They do dividends and they do share repurchases depending on the available cash flows. This will likely be lower next year especially, but they are still saying they will pay a dividend 30 to 40% of net income, and then if there is an opportunity they can also do M&A. Perhaps because of the downturn there will be M&A opportunities. If we go into the outlook, you can see here combines down, tractors down in North America. North America has really been hit, mostly South America, and that flat. This was the first hit segment in 2023. They expect South America to stabilize or maybe rebound in 2025, but that all depends on how this food pricing, tariffs and all will move across the globe going forward. If we look at net assumptions, EBIT also a little lower in line with Q4, so revenues down again, perhaps even 20%, 18% down. So this can still look uglier going forward. If we look at the industry unit forecasts, decline, decline, decline. So we will see how it works for construction also. EBIT down, very low, even lower than the current EBIT. If we look at the financial targets, estimation decline. They say maybe they are too conservative, but these sales are lower because they still need to manage those inventories. They say they are still not at a healthy, stable run rate with inventories with dealers. So that's something that will still impact sales going forward. They hope to maybe stabilize towards the end of the year. Some free cash flows from 200 million to $500 million, depending on the situation, and earnings per share down from 2024 to 0.65, 0.75. When we look at the outlook and priorities, they are still investing in key investment technologies, lower production, and you can do what you can do, but if there is a downturn, there is a downturn. Investor Day to be held May 8th at the New York Stock Exchange. And this is key. If we look at their total capex spending for the years, they are doing 800 million per year, and they will likely continue investing in digitalization for the equipment and other new programs. They're investing more likely than Deere on this specific agricultural segment. We'll see about that later. There is debt, significant debt, 15 billion, but that is then mostly with the financial services, which is structured. Maybe they can sell that debt if they want to, but they say the returns on investment on this financial part is in line with their expectations. Let's look at the conference call a little bit. I have gone through the complete conference call and I'll give you the key its and bits of the analysis. Gerrit Marx is the CEO, came back to the company. He's discussing the savings that they are doing, challenging market environment, and they want to survive the downturn and then grow going forward. This is the story, the key story, how things work. We have depressed commodity prices. Those prices weigh on farm income, which in turn lead to softness in equipment demand. That is the perfect description of the cycle. Overall, inventory levels are still too high, assuming their 2025 market forecast isn't too conservative. That will lead to a decline in sales. We have seen a little bit stronger than market declines because they still want to clear some inventory. From the financial services, delinquencies are at reasonable levels and our return on assets is where we want to be. So still surviving situation for farmers, still profitable, which is then okay. But this is another risk just to keep in mind if there is a more severe downturn. Now, cash flow, there was an outflow of 400 million that impacted the full year cash flow from payables, receivables, and then also retail incentives, wholesale inventory reductions. So there is always this cash flow issues that can be positive, can be negative, depending on the temporary situation. Construction, again, huge decline, 33%, and likely to continue that way. Financial services, stable, but there are lower recoveries on used equipment sales. So those that go delinquent, the price also on used equipment goes down, which is then also a risk that is increased with these companies, car companies also, that go into the financial services arm of the business, because food prices are still likely at a profitable level for farmers, but you never know. If food prices go lower, then it can be unprofitable for, I don't know, farmers in North America or Latin America, and then they just return the equipment and then the company is in a pickle. So just a risk that hopefully will not materialize, but to keep in mind when it comes to these cyclicals. There will be more headwinds that will face the company in 2025. There is a lot of geopolitical uncertainty, tariffs, how their material flows and how will that impact the company. And there is also here a discussion on passing the cost in the pricing. So if there is tariffs, that increases also the cost for farmers. So suddenly North American farmers could be at a disadvantage because of tariffs. It's not that straightforward as always. In 2024, they returned approximately 1.3 billion to shareholders through dividends and share repurchases, which is good, but still on a good return from 2023 and the cash flows, and they will continue their annual dividend 30 to 50% of net income and will try to maintain the share repurchase program depending on available cash flows, and then also if there is opportunities for acquisitions. In the aggregate, they expect global industry demand to be down 5 to 10%. North America will be down the worst, 10 to 15% down, and also for their revenues as they still manage those inventories. Production hours are planned to be lower again, and they try to hold, if not grow, market share. They expect the industry to reach the trough during 2025, but it's still too early to say how long it will remain at that level. The dip of the sector decline does not mean the market turns up right after, only that it should not drop even further. So 2025 should be perhaps the bottom, and then we have to see when, maybe 5 years from now. That is the issue with cyclicals. But this also gives you, that's why it's important to listen to these conference calls. It gives you great insight into what's going on with the sector, also for other companies. So we are now, this will likely be the bottom. And here 2025, 2026 might be the best opportunity to buy something like this. If we look at our risk and reward quadrant, let's now check first the perspectives. Also on the industry, we have discussed Archer Daniel, Nutrien. I'll write again the deep analysis on ADM soon as the earnings are out. But look at my exposure with those companies. So food, the downturn might still last for a few years, and I have here in the diversified portfolio 4% ADM. In my other portfolios, the model even less, and I personally, in my personal portfolio, don't yet own food. I'm still waiting for better entry positions. There is just 2% of Nutrien, and I do not own for now, but I have no intention in buying in the next 2 days, CNH Industrial. I'm watching as a YouTube situation, and then we'll see how the industry moves. When is the best time to buy something like this? That is the key to understand. If we go to analyst questions, those questions are usually mostly focused on the short term, because that's what analysts, their job is to model for the next quarters and maximally a year. But still, there is this good question on tariffs, and perhaps a good answer here to understand how these tariffs might work. Relocations of production back to the US, even partly assembly, there is nothing we can do earlier than 20 to 18 months from the day we take the decision, provided we are having a brownfield facility available, which we have, by the way. So 18 months to just start transferring. When you make a good decision, you are sure that tariffs will be there for the long term. But if tariffs are there on Friday and the tariffs are not there on Saturday, or delayed, or things like that, that doesn't help producers. So this is very volatile environment and hard to make business decisions in such a volatile environment. And you have to make a decision 18 months from now. We have just already midterm elections in the US, and then you never know what will change. So it's very difficult for businesses to read the situation, and that's why also it's cool to read these transcripts and listen to the conference calls to understand what's going on. And also farmers, when it comes to investing, they are holding because they first want to get certainty about their end markets, the profitability of new investments, the deals there, the administration, and what's going on. So that is the situation now, very uncertain, and that's what the company needs to manage. This is just typical analyst question, something for the short term. What did they plan, this and that they put into their models, but that's not really that important. There is this question, how they are going to pay the dividend and the buyback. So the policy for dividends goes between 25% and 35% of net income of previous year. So we had $1 of net income, so the dividend might be 30 cents for 2025, and then 20 cents for 2026. So dividend will likely be declining, and that is also something that could hit the stock price, creating more opportunities. Now, when do you see the declines in retail demand neutralizing 2026? That's a good question, but we don't know. It's hard to assess, and farmers again are waiting for the farm bill to come out to better understand things, and we will see how that works over time. There is a lot of uncertainty. Now, when it comes to the company, they are public for 12 years now on the New York Stock Exchange. They opened at $12 12 years ago, and they are still at 12 years. However, we have to understand that they were with Iveco, the truck manufacturer, and they have demerged in 2022. So it's hard to compare numbers before 2022 now for the company, but we can still make a stock valuation on what we have. The market capitalization now is 15 billion. The dividend yield is 3.7%, but will likely go lower as they lower the dividend payout. And here you see before the demerger changes in revenues there. But I'm looking at the company in a downturn. They are not really profitable. Then they made 2 billion of profits in good years, and now they are down to 1 billion. If we look more deeper in the previous years, you can see here that there were 3 years when they didn't make much money. This is also trucking Europe related. But again, here they did okay. And that is the cycle, and this is exuberant times, this is now mid-cycle. Maybe there will be another downturn, but let's say a conservative estimation would be that they make 2 billion in a good year, half a billion in a bad year, and average, perhaps over time with some growth, 1.3 billion. And you can see here those flows into ups and downs depending on the cycle. There are significant liabilities, mostly for that financial division that they have, which likely increases some profits, but also increases a little bit the risk. If I look at cash, if you always look at these businesses, when they release inventories, that is then always a positive on the cash flows. So they reach 2 billion of cash flows from operations in the last 12 months. And you see here the good capital expenditures where they are still investing in developing their business. I think there will be 200 million for the dividend, maybe some buybacks from 2025. Let's see how that works from an investing conclusion. 1.2 billion per year, earnings per share 1.16 on average, 0.7 will likely be the earnings for 2025. We have food sector global growth, so the demand across cycles should grow. Keep in mind the cycles, because with cyclicals you can buy them sometimes when things look bad at 20% average cycle returns. And 2025 will not be better. Will the market be patient with the stock, or will it punish on worse news going forward? When it comes to analyzing cyclicals, this is the key video you have to watch. Peter Lynch, One Up on Wall Street, and he also explains how to buy cyclicals. If I go to that video, check that video please. The cyclical expectations are for a company to flourish when the economy turns good, to suffer when there is no economic growth. 50% drops are normal if you buy at the wrong part of the cycle. You can wait years before seeing another upswing. Years, even 5 years, that's not a problem. And then large and well-known companies that make the January stock picker most easily part with his money. We'll discuss Deere in a moment. Timing is everything. Watch for inventories and for new market entrants. Stock usually declines when peak earnings is reached and investors expect next recession. Know your cyclical and figure out the cycles. 3-4 bad years in the automotive industry, something like that also in the food and machinery industry. It's easier to predict an upturn, which is what we are watching, than a downturn in the industry. So this is the situation now. You can see here these cycles, and if you nail at the bottom of a cycle, you can have a good return, good dividends, good numbers as those things turn around. There are competitors, and you can see here, this is one level, then the exuberant level, and we are still at the mid-cycle level. Deere is still booming. I don't know why, maybe it's become a darling of the market, but the numbers are declining, so likely the guidance is also to decline. Q4 results in line with the market. Net operating cash flows, if all else is equal, 4-5 billion. If I compare that to the market cap, that's a P ratio of 30. So 25, 30, that's very expensive. Maybe it is some part of an index of who knows what. I didn't dig deeper into Deere. Is there a buyout? What is pushing the stock price higher? I don't know. This looks like, okay, famous name that investors will part their money with. Nevertheless, if we look at the forecast also from Deere, huge declines going forward for 2025 also. So I don't know what the market is looking, maybe the growth in dividend, but let's analyze CNH. So I have added it to our intrinsic value template. If we look at the situation, earnings per share 1.16, I cannot really go into cycles here because I don't want to predict cycles. But if we put a growth rate across a cycle of 5%, a discount rate of 10%, a terminal multiple of 15 on earnings per share, dividend payout ratio 35%, so there is some income there. The intrinsic value is $13 over the long term. The discount rate expected return 10%. If we go back to our comparative table there, you can see here that it is now leading to an 11% long-term return. However, with cyclicals, you can sometimes buy them at 20%, not just 10%. If we are now, the stock price here is offering 10%. In a downturn, maybe on bad situation in 2025, you can buy them at 15% average cycle earnings, and then it would be a good strong buy. Now you can start building a position, you can start managing, you can start watching it, and because of that cyclical risk, I have just put it a little bit lower in the risk and reward quadrant on the risk side, so higher risk for the company on that 10% cyclical return. The conclusion, likely to give a 10-11% long-term return at the moment. There are dividends, buyback, there is the food cycle, food sector, long-term growth, the structural growth, tailwind. The food sector has always issues but grows across those cycles. Looks like a fair business, not a great business. Keep in mind the cycle and try to increase the position when things are ugly. I will keep watching, maybe small position, then increasing, getting some dividends. And that is the story of CNH Industrial. Thanks for watching. If you like this deep dig, subscribe and check my research platform for more updates on yearly earnings on covered stocks.